Hey guys, welcome to Make Money Count. I'm here in the podcast studio alone because our friend Marcus is joining me via video link from Greece. Our war correspondent Marcus. Say hello.
How's it going, buddy?
Listen, Marcus, the first article that I have is just chatting about this 30-year amortization change in insured mortgages that happened last week. So on the 1st of August, if you don't know yet, the Canadian home purchaser can now take a 30-year amortization if they're purchasing a pre-construction condo if they're putting less than 20% down. And before, the rule would be that you have to take a 25-year amortization if you're putting less than 25% or 20% down. I'm sorry. So they extended that to 30 years if you're buying a pre-construction. And the article here just kind of talks about that. I don't think it's really going to change much, right? Like I don't think there's going to be much of a change here.
Flop. This is going to be a flop.
Yeah, no, totally.
This is like smacks of like one of those like government ideas that's like so transparent and believes that like it's rooted in this belief that the Canadian consumer is just a sucker, right? Like, hey, like to help developers, we're going to let you qualify for products that are really, really expensive by putting less down.
Right.
Like get lost, like resale condos have fallen to like what on average of like $900 a foot now in Toronto. Pre-construction still selling at $1,400 because municipalities are broken, because costs to build condos are high because of what cities charge for development charges. They're high because of what workers get paid and what materials cost. And they're high because of interest rates. And they're sticky. New construction condos, new pre-construction stuff isn't coming off. The price isn't changing on that stuff. And resale is tanking. Okay. So with Canadian government, in order to help developers, is going to let Canadian consumers who are already getting smoked buy pre-construction condos with 5% down. Okay, more questions for you now. If we're going to do that, what bank is going to fund the inflated price? Are they going to keep funding these prices upon closing when the price of the new construction condo is so much higher than the market rate for them?
I mean, that's kind of what I was thinking. Like, I think some sort of good policy would be, or like some sort of new change would be kind of like an insurance on the gap between the appraisal and what it was purchased for, because these pre-constructions aren't coming in at the value that it needs to be to get financing. That would be interesting. The other thing too is most pre-constructions that you buy have a deposit structure of 20%. So like, okay, there's these people who can't afford to put down 20%. That's why they're taking an insured mortgage. And then most of the developers now, I mean, most developers in general, especially, really good projects that you want to be involved in, require a 20% deposit structure. I mean, you get that back if you do an insured mortgage at closing. But I mean, if you don't have it in the first place, then why would you purchase? You know what I mean? It doesn't make sense.
Yeah, that's what I was going to say. The second problem that it introduces is builders, in order to get financing, in order to build these condo buildings, rely on receiving 15 to 20% of the purchase price in deposits in order to satisfy whatever financial institution is giving them the money to build the building. So I guess we can expect now financial institutions are going to be okay with receiving less of a deposit for the sale of new construction. It seems like a rather perilous time to do that, especially considering that we're already seeing buyers walk away from 20% deposits on new construction stuff. And then there's another small issue, but probably can be mitigated with an increase in the loan that the developer receives. But typically developers borrow against the deposits that they accumulate, right? And it's not for a huge portion of what they're building for, but still it's a portion. So now you're going to have either buyers buying with 15 to 20% in deposits and then waiting to get that cash back when they finance their condo, or putting significantly less as a deposit on condos that are priced out of market and have everybody like fingers crossed, white knuckled up until the closing date to in hopes that condo prices have elevated to the point where they bought their pre-construction. Listen, I just think the policy is flawed. And like typically what happens, like when the city of Toronto increases development charges as the market is tanking, right? Or a policy like this gets enacted. It's like the policy's been in the works for a little while. So they were like, oh, this will be great. And then once it comes into the market, they realize, oh, the market's super broken and this thing doesn't work at all. Maybe it's a trial balloon for more. Maybe they plan on meddling a little bit more in the market. Listen, the only screwed up thing here is that if people stop buying new construction, then condos stop being built. And if condos stop being built, the thing that we've been relying on for not only a huge part of our GDP and our employment, but also for our housing supply, which is, we're told, extremely, extremely important and very required and at levels that it shouldn't be and the lowest in the G7, which I'm now becoming very suspicious of. But we're not going to get more housing supply if developers don't build buildings.
Listen, article number 2, I'm not really going to talk too much about, but it was about how first-time homebuyers are relying more and more on gifts from family. And they were talking about, average gift amounts and stuff like that. I was very surprised. I never got a gift for my down payment. I wish I did. But
I'm sure your mom would have liked to have given you a gift. I know your mom.
No, I know. She painted my house. So that's even more annoying than giving someone a gift. Painting's terrible.
She's given you everything she can. So maybe stop being a jerk.
Guess what the average gift in BC is? The average gift amount. This is blowing my mind. $204,000 is the average gift amount in BC, and the average gift amount in Ontario is $128,000. That's crazy. That's a lot.
And it's coming out of probably equity too, right?
Yeah, like downsizing families. The parents sell the house to move into a condo because the kids are gone, and why not give them some of their, they're going to get it eventually, I suppose.
Yeah.
But interesting. We'll post this article. But I think the third article that I pulled, which I was very excited about, is 4 mistakes that mortgage shoppers should avoid, which I thought would be interesting to chat quick about. Point number 1 would be not getting a pre-approval before shopping for a house, or not getting a pre-approval to lock in your rate before shopping in for a house. And pre-approvals are good for 120 days. Any mortgage broker can get them for you. I think that it's just a common thing for people, like talking to your real estate agent or a real estate agent is just so much more exciting than finding out that you don't qualify for as much as you had hoped. So I feel like people are just naturally drawn to talking to their realtor first.
I would add something like as a caveat or like an asterisk to this one.
Yeah.
If you get a pre-approval, like make sure it's a good one, right? Like, because you could really get screwed up by a pre-approval that you get from a bank that doesn't consider property taxes or condo maintenance fees. Like, we've seen it so many times where, someone goes firm on a house and they come in and, oh, my bank said that I was pre-approved, but then when they did the numbers, I wasn't pre-approved anymore. Like, it can get pretty scary. So, I would just caution people on that.
Yeah, it's a very common thing. And it just comes back to the whole idea that, bank employees, luckily enough, don't have to have any sort of training or any sort of knowledge in mortgages to be able to advise on mortgages. But I've yet to really have too many conversations like that where someone came from another mortgage broker, but mostly with the bank. I walked into my bank. They told me I could buy for this. Now I bought the property and they're telling me they can't help me. And, it's kind of like a shrug your shoulders thing from the bank. And it's sad because this is like the biggest purchase that most Canadians are going to make in their lives, right? So
I think like it comes down to 2 things. Number 1, be honest with whoever you're dealing with for that pre-approval. And if they're good, they're going to ask some deep dive questions, right? Like, we want to see your job letter, your pay stub. We want to see some of your documentation while we're working on your pre-approval so that we can be sure that the pre-approval is going to stick. The other thing that we'll do while we're working through with our clients on a purchase, although it doesn't seem like there's so many purchases happening right now. But the other thing we'll do is as you find properties, send them to us. And then we'll run them through our system. We'll make sure that the value is going to be there when it comes time to put your offer in or when your offer gets accepted. We'll make sure that the property fits.
Yeah, absolutely. Absolutely. Number 2 on this list, which I'm excited about, and I know you're going to be too, is the second biggest thing to avoid for rate shoppers or more people are shopping for mortgages is taking the first rate offered by your bank. It's so common, right? Like people go into their bank and they just do what the bank says because their bank said it, right? And we talk about this all the time. Your bank's not your best friend. Your bank's not your friend at all. They're the friend of the shareholder.
Your bank is not your friend. Yeah, it's the opposite of your friend.
Yeah. Enemy, some may say.
Yeah. So understand, like, especially on like mortgage renewals, the bank is going to send you a renewal document, and that renewal document is going to have the worst rates you have ever seen. And they are relying on you to not phone them, just to fill that form out and send it right back. And it is your responsibility to make sure that you fight for the best possible rate on your mortgage renewal, on your mortgage purchase. Call a mortgage broker, call your bank, like beat that rate up.
Which number 3 actually was immediately signing your renewal offer. It's like you wrote the article, you know, like you knew it was coming.
Don't sign it immediately. Yeah.
Yeah. So yeah, exactly.
Listen, it's so simple. The banks prey upon consumers. They are super, super intelligent. They are super connected. They have lots and lots of money. And they are doing everything they can to get as much money out of the Canadian consumer as they possibly can. Know that when you go into battle with them to get a rate for a purchase, a rate for a renewal, whatever it is that you're doing, understand your enemy. Understand that the more products you have with one bank, the worse they're going to treat you. Think about it. If you have your RRSPs, your bank accounts, your credit cards, your line of credit, and your mortgage, all sitting with one bank, whether it be blue or green or red or beige or whatever. That bank, I don't know which one's beige. I was thinking more like burgundy. It's burgundy and gold, CIBC.
Oh, yeah.
Anyways, that bank knows you're loyal, and they're going to use that loyalty to charge you as much as they possibly can because they know you're not going anywhere.
Yeah, no,
you know
definitely
what?
not.
Show them you're willing to go places. They don't like you more because you have all of your accounts with them. They treat you worse because you have all of your accounts with them. Okay, that was 3. What's 4?
4 is locking into a long-term fixed rate. It's like we wrote this article. This is what we talk about all the time. You know what I mean?
Interest rate differential penalty. You're going to get smoked. No, not a time for fixed rates right now, people.
No.
It's a time for variable rate mortgages. It was a time for fixed rates.
And if you're going to take a fixed rate, make sure it's not too long. 1, 2, 3 years max.
Yeah.
And talk to a mortgage broker. Doesn't have to be us. We'd love it to be us. But talk to a mortgage broker because they're going to be the Napoleon in your fight with your bank. So, and you can quote that.
Like use that when you go into your bank. But listen, it's really important. Variable rate mortgages right now, although they seem unappetizing and they're beaten up, and banks will push for long-term fixed rate products, you need to be your own advocate. You know, banking is kind of like healthcare, right? Like you can't just go into a hospital or to a doctor and just expect everything is going to be perfect without being your own advocate. Same thing with your finances. You've got to be your own advocate. And even more so with your finances, because with your finances, if you're dealing directly with your bank, the person on the other side of the table does not have your best interests in mind.
No.
They have their best interests in mind.
No, definitely not. I think this was great. I think we put a stop to it there. And
Justin, you're the best.
I know. People tell me all the time. I'm just joking. Hit like, hit subscribe, leave us a comment so we know what to talk about, and we will see you next week.
Send the episode to a friend of yours who is looking to renew their mortgage right now, because you probably don't have any friends that are buying. If you do have a friend that's buying, they're probably not stupid.